Welcome to another S&P 500 analysis. Today is January 17, 2022. Last week, the S&P 500 continues to experience high volatility. We saw a strong bounce starting on midday last Monday after the S&P 500 has pulled back approximately 5%. Then the selling resumed on Thursday and ended with two consecutive losing weeks. Is this volatility a sign of a major correction? Before you conclude whether this is the beginning of a major market correction or not, and by major I mean at least 15%, I will show you something the market did last week that most market participants have missed. Then you can decide whether or not this is the beginning of a 15% or more market correction. Stay tuned. Let's start with this weekly chart of the S&P 500 and see what it did last week. We saw a range of 166.59 points, so it's almost 167 points. And out of the entire volatility of this entire 166 point range, it only ended the week losing 14 points or so, or 0.3%. So essentially, it pretty much finished the week where it started. And right now, we are seeing a weekly one-time framing down and still inside of this channel, so wouldn't be surprised that this thing will continue to chop inside of this channel. And until the price break this price channel, we're still looking at this price trend on a weekly basis as it's being up. Let's take a look at last week's intraday chart of the S&P 500 and some of the internals and also the sentiment. As you can see, the S&P 500 came down on Monday and made a low in mid-morning or late morning. Then in midday afternoon, it started to lift and came up. And on Tuesday, it had a follow-through and continued to lift. Then on Wednesday, after the first 45 minutes or so, sort of made a top here and start to stabilize, essentially doing some little bit of a balance, and ended pretty close to where it opened for the day. Then on Thursday, it tried to come up and test the high, was unable to get up to Wednesday's high, and then it started to pull back. Then we see the selling start accelerating as the day progressed. Then on Friday, we saw a little bit of a balancing throughout the morning and early afternoon until the OPX, the weekly OPX option expiration shenanigan came in. And we see the price starting to lift back up. And also notice the new high, new low. On Monday, we saw more new low than new high. Then on Tuesday, Wednesday, and Thursday, the new high actually outnumbered the new 52-week low, even though we saw Thursday the selling resume. But then again, on Friday, we saw it the new low start to dominate once again, and it ended on Friday with 104 more new 52-week low in the New York Stock Exchange and a new 52-week high. Similarly, on the up-down volume ratio, we see more selling than buying on Monday. Then on Tuesday, Wednesday, and Thursday, we started seeing a little bit more buying than selling, although we had a little bit of a certain spot of selling there. Then at the close toward the Thursday close, we saw a little bit more selling coming in. Then on Friday, we see the selling continue throughout the session until the last 30 minutes or so before the close on Friday. And that's probably due to some option expiration, balancing or, pairing out some of the position. Then on the VIX, we see on Monday, the VIX came up to above 22 during this low here, and it started to come back down and dip below the 20 level. Then on Tuesday, we saw a little bit above the short period of about 20, and it dipped back below 20 and stayed there for the rest of the session and throughout Thursday. Then on Friday, we saw it come back up above the 20, and once again, as it approached the close, the OPX shenanigan pushes the VIX back down and close below 20 and close Friday at 19.21. And also you see the put call ratio. We got the put call ratio above 0.7 on Monday. Then on Tuesday, Wednesday, and Thursday, it's pretty much stay below that 0.75. Then once again on Friday, it came back in and sitting above 0.75 throughout the entire session, even though we saw this, OPEX shenanigan in the late afternoon. The put-call ratio is pretty much stable, sitting somewhere around that 0.8, 0.85 area, and it closed at 0.85 on Friday. And the advanced decline, the daily advanced decline, we see on Monday there were more declining issue than advancing issue. Then it started to turn around after first couple hour trading on Tuesday, and the advancer overtake the decliner. Then on Wednesday, it's pretty kind of flat, even though it finished with a little bit of more advancing issue than declining issue. Then on Thursday, it got a little bit stronger throughout the entire session. There were more advancing issue than declining issue until near the close. Then on Friday, even though we saw a little bit of a lifting up throughout the close into the close, we're still seeing more declining issue than advancing issue on Friday, and it closed with 694 more decliners than advancers. So in terms of the daily chart of these market internal and sentiment, let's start looking at this sentiment chart here. As you can see that the VIX closed down below the 20, and we have this put-call ratio above the 0.75. So the market participant are putting on some hedge and protecting some potential downside, even though the VIX doesn't show them to be panicking, but it is approaching that fearful level near that 20-30 zone. And here we could see the up-down volume ratio is sort of a little bit of a mixed bag. On Tuesday, we did see a strong day here on the up-down volume ratio, and there was some strong buying, like 5-1 in favor of volume. Then looking at the daily advanced decline, we did see a broad market participation on Tuesday with 1,564 more advancing issue than declining issue. But once again, on Friday, that kind of dipped back in favor of the decliners. And for the new 52-week high versus the 52-week low, we did see the new 52-week low, the number of stock making new 52-week lows starting to expand once again. And on Friday, we saw it 205 stock made new 52-week low versus the new 52-week high. We're seeing 101. So the number of 52-week high is relatively stable throughout the week, but we did see some more stock making new 52-week low. And looking at the New York Stock Exchange cumulative advanced decline line, we did see a little bit short-term positive divergence here. As you can see, this low here and versus this low, this is a higher low. And here we're seeing the S&P 500, although it closed a little bit, on a positive slope here on Friday, but the trend is also a negative sloping trend. So we are seeing a little bit of a short-term positive divergence. So I wouldn't be surprised that we will continue to see a little bit more of an upside move in the short term, unless we see this advanced decline start to accelerate and take out this low here. But again, bear in mind, we are still dealing with this little bit of a longer term divergence here, this negative divergence. Now let's take a look at the Nasdaq internal. As you can see on the up-down volume ratio, it's pretty much doing the similar thing as the New York Stock Exchange, and also the advanced decline. We did see the decliner outnumber the advancer throughout the week, except on Tuesday. And for the Nasdaq new 52-week high versus new 52-week low, we also saw the new 52-week low expanded upward, and once again it's back up to this 600, 700 level. It closed on Friday with 685 new 52-week low versus only 77 new 52-week high. As you can see, the new low outnumbered the new high by a number of 608 on Friday. On Monday, we saw 725 new 52-week low versus 75 new 52-week high, and the new 52-week low outnumbered its 52-week high by 650. And for the Nasdaq cumulative advanced decline line, we're actually seeing a negative divergence. And on Friday, there were more decliners than advancer, but the Nasdaq 100 actually closed up. So once again, we are seeing a little bit of a negative divergence, but the primary one that we are watching is this humongous negative divergence on the Nasdaq, and that kind of highlight the internal weakness of the Nasdaq. Now, before we take a look at the price action of the S&P 500, I just want to go back and review some of the pullback that we've seen for the last couple of years since the pandemic. Here's the pandemic pullback, or pretty much, that is a black swan type of a sell-off, 35%. Okay. Since then, we basically had a 10% correction from this particular pullback, and then follow up by 8.9%. Then all of a sudden we just have these, 5% or so pullback. And right now, the most recent one, we are just looking at close to 5%. Here's what we're going to take a look at to see what if the price start pulling back below this trend line here, and what are the percentage. So let me go and zoom this in, and then we could do a little bit of a what if type of analysis here. Okay, so basically just going to use this one here. Okay. Right now, we essentially is here at this Monday's low, okay, and that result a 4.89%. Now, if I come down and do this particular pivot, essentially this pivot high here. So if we're going to come and do the pivot high, that's essentially 5.6% or so. And if we come down to this low here, essentially filling this gap, and that would brings it to somewhere around slightly less than or close to 7%. And here we are getting down to close to 8%. If we come down and fill this gap. And then here on this gap, we are getting to 9.5%. And if we come down to this pivot low, right, if we come down here, then that's where we're going to see 11%. Okay, so still, it's not anywhere close to what we would consider a bear market or a market crash. Okay, so until we see a break below this low, then we're going to go and reassess to see, is the market really going to bounce, or is it really going to crash? Now, the thing is, if we come down to this trend line here, and that is essentially, this right here, this gap here, and that's only a 8% correction, this gap here, filling this gap. So those are some of the level to keep an eye on, and some of the percentage to pay attention to see what phase of this pullback or the market cycle is actually in. And remember, I still haven't shown you, what the market did to tell me that this is just a dip. Now, I'm not saying that the market won't crash. Okay? The market will get into a bear market, and it could, do that when the Fed actually start hiking rate. But for now, if you are looking for a crash, you're going to be disappointed. So now let's go and take a look at some of the possible scenario for the coming week or so. If it get a little bounce off of this 618, would it be able to get above this this pivot high? And if it break this trend line here, essentially dip back below the 618, then look for this retracement down to the 50% area, and essentially come down and test this pivot high near the 45.85. And if it doesn't get a bounce back up to come back and do a back test of this particular trend line, or essentially back testing the 618, then look for this thing to dip down to this trend line here and fill this gap at the 38.2, somewhere around the 44.85. So those are the up-down scenario to keep an eye on for the S&P 500 in the coming week. Now for the Nasdaq 100, we're looking at this trend line here. So if we're going to break this trend line in the coming week, then watch for this thing to come down and fill this gap down here. And this level here is somewhere around 14,880. And if it doesn't hold this gap or get a bounce off this gap, look for this low to get tested, and that would be somewhere around 14,384 or 14,385. So that would be our downside scenario. But if it get a bounce off of this trend line, then look for this pivot high here. That would be somewhere around 16,000 level to see would it be able to get back above this 16,000 level. And if it does, then look for this particular pivot high somewhere above the 16,600. And for the Russell 2000, you see the Russell 2000 is down here now, back to this 2134. Right now, we're basically looking to see would it be able to get a bounce back up. And once again, 2195 would be a point to keep an eye on. And if we get back above that, then maybe it will get another attempt to retrace back up to the 2318 area here. But if it breaks, then we're essentially looking for this thing to come down, 1935. We won't even be paying attention to this 2075 here. We're essentially looking for this range extension move down to this 1950 area, and that will bring it down to somewhere inside of this range here near the 1935. And for the Dow Jones Transportation, it seems to be just kind of chopping around inside of this retracement zone, right, between a 618 and a 38.2. So we're going to continue to watch to see would it be able to do another bounce like this up and down. But if it break this 15,610 area, essentially break below this 38.2, then watch for this thing to come back down. And here are these potential support here, but essentially we're still looking for this gap to get filled down here at the 15,067 area. Now, out of all the index that we looked at so far, the Dow Jones Industrial has been holding up much better than the rest of them in the recent past here. Right now, it's sitting above this 35,625. We want to see would it be able to bounce off of that and then come up. There's a likelihood that we could see another new high for the Dow Jones Industrial. Now, I'm saying the Dow Jones Industrial, no mention of all the other indexes. And I'm going to tell you why I believe that the Dow Jones Industrial, and there might not be other indexes, will accompany the Dow Jones Industrial to make a new all-time high. But if it breaks below this 35,650 or 625, then look for this trend line. Essentially come down and test this trend line and this pivot low somewhere around 34,000. So essentially that's what the upside and downside scenarios are. Now here's the New York Stock Exchange Composite Index here. That's basically is an index of all the 3,000 plus stock that are traded in the New York Stock Exchange. How many of you have noticed what have transpired last week from the New York Stock Exchange Composite? If you look, on Thursday, it actually put in a new intraday high. The day before, actually it closed with a new all-time closing high of 17,353.76. Now, why is that important, you might ask? The Nasdaq 100 didn't close new at all-time high. They're not even close to it. Neither is the S&P 500. And the Dow Jones Industrial did not close to a new all-time closing high. But the New York Stock Exchange Composite Index did. So how could that be? Right? You got all these heavy large cap tech stock coming down because the Nasdaq and the S&P 500 have shown us that these heavy large cap tech stocks have been weighting down on the index. But the New York Stock Exchange Composite is pushing up to a new high. Well, remember we talked about the rotation, the defensive stock, the value stock. that 3,000 some odd stock traded in the New York Stock Exchange is not only tech, and it is not heavily weighted by the tech stock like the S&P 500 that is heavily weighted by the FANG stock, and so is the Nasdaq 100. That's why this is important. It shows you the rotation and also the other sector of the market is pushing the composite, the New York Stock Exchange composite to a new high. And that's why the Dow Jones Industrial has been holding up much better than the S&P 500 and the Nasdaq 100 because of the financial, the industrial, the energy that's holding it up. So here's the thing. When we are back in the days, I mean, we're talking about many, many years ago, before the dot-com, the Dow Jones 30, the Dow Jones Industrial, is the key index that we gauge the market on, not necessarily the S&P 500. Because back then, the Dow Jones 30 is the bluest of the blue chip. Yes, right now we're basically looking at tech stock, right? Everybody is jumping on the bandwagon of the Nasdaq 100. But as the market rotating back to what we call the old smokestacks type of stock, that is basically the industrial, the energy, and all the other defensive stock, you will see the Dow Jones Industrial will be the last index to put in the top when the Fed stop the music and take the punch bowl away. So keep an eye on the Dow Jones Industrial for a non-confirmed top. Now let's take a look at the SPY, the ETF for the S&P 500. Here we are looking at a 60-minute chart. And essentially looking at these high volume zone, right? These are some of the locations that we want to keep an eye on. You see up here right now, it's coming up on this value area low, this composite value area. So this entire is a composite value area right now for this particular range of time here. Okay, so we're basically looking at this particular range. And here is the value area, and we see that there is a composite point of control up at 477. And right now, we're basically sitting here at this 465 area. So right now, if we could get up and get back inside of this high volume area and could hold above this 465, then we expect this SPY could try to retrace back up to the 472. But if it come up or get rejected and backing off from the composite value area low, which is this 465, then I expect it to see price come back down to this 460 area, this 460 and a half or so, and maybe get a little chop, then it proceed down to the 456 if it doesn't get a bounce back to back test and try another attempt to try to get back into this route to this high volume zone here above the 465. So keep an eye on the 465 next week. If it go above and stay above that, then look for a possibility of the SPY moving up to the 472. But if you get rejected and pushed back, dip below the 465, then look for the 460 and a half and then 456 and a half or so, because there's this gap here. Okay? So essentially, and also this Monday's low. So we could come back down and retest this Monday low. And look at the Nasdaq 100 ETF, the QQQ. We see that once again, price is sitting right at the edge of this composite value area low here, somewhere around this 380 area. So we want to see would it be able to stay above that. If it does, then look for this thing to come up, try to retrace back up to this 389 and a half. And if it could break through into this little bit of a low volume area here, then it could push up to this 393. Now again, we're basically looking at this entire zone here as a value area or balance area. We do have a little bit of a low volume area. So this is like a little bit of a capital B shape type of distribution, a double distribution value area. Okay, so we could see that little bit of a rejection here that could push it back down when it get up to this area or we could just move right through and then start chopping up and work toward the value area high. Now the composite point of control is sitting up somewhere around 397.5. So on the downside, if it unable to move up here into this zone, then we expect it to come back down and once again trace down to this 370.5 and test this area here, which is the Monday's low. Then depending with this hold, just like the S&P 500, and if it doesn't hold, then we're essentially gonna see what we trace back down to this 360 area and essentially fill this gap here. And now we're looking at the IWM, the Russell 2000 ETF. You can see that it is pretty much still inside of this balance area here. And right now, once again, it is back down to this lower area here at the lower edge. So we're going to see what it be able to, bounce up and come up to this 221, this composite point of control here on this balance area. Or would it break down and dip below, the 212 and then work itself back down to somewhere around 205 area. So we go and take a look on a daily. And here's a daily chart of the IWM. Remember this balance area that we just looked at on the 2-hour chart. That was a 2-hour chart for the IWM. And we're saying that if it breaks below this zone here, this balance area, then we're essentially looking for this thing to come down to this 305 area here. And essentially that is between these this pivot low and this pivot high. So we're going to be watching to see would it be able to get a bounce back up and try to get back up above this 230 and break out of this zone and see would it be able to work itself up toward this 235. I doubt it will come up and try to get a new all-time high in the near future. So we'll see how this rate hike thing gonna go. And I think if the economy falter and get into a recession, it's not going to be good for small cap. So we're going to be looking at somewhere around this 205. Now let's take a look at the 10-year yield. I have a weekly chart of the 10-year yield here. As you can see, there is a possible cup and handle here on this huge cup and handle, right? And I have a projected major move up at 618 at 2.55, somewhere around 2.5%. And at 100% major move, that will be somewhere around 3%. And also, if we take a look at the near term, we could see this smaller cup and handle. And with this, we have a projected move of 618 somewhere around 2.2. But at 100%, it's pretty close to 2.5%. So I would say the market probably be looking at 2.5% on this, these two cup and handle pattern here. Now let's take a look at the US dollar here. You see the US dollar pull back below this 95.7. Remember we were saying that if it come down and unable to get up to this 97.79, then you pull see it, would it be able to hold this 95.7? And if it doesn't hold right now, it seems like it might try to break this trend line here. Once again, we're basically looking at the weekly price here. So we'll keep an eye on this, $94 area here to see, would it come down and test this 94 for support and see would it bounce back up and make another move toward this 97.79. But if it dip below this 94, then we could see it chop around and look forward to chop down to the 92 area. Not saying that's what they're going to do next week, but that would be one of the target level to keep an eye on is 92. And here looking at the crude oil, it's basically just watching this trend line here. It broke this trend line up at this 76, 77 level, came back down, and a lot of people was basically calling a top for the oil at this time. But then saying that we still maintain to see this thing come back up to this 85 and possibly to this 90 area. So right now we're still watching for that 90 level here. So I wouldn't be surprised to see oil continue to move up to this 90 and a half location. So, but if it come back down again, we're basically looking at this 77 as the support level here. So 90 and a half and 77. So those are the two numbers to keep an eye on. And silver is still chopping around, trying to hold support at this 2272 level. So keep an eye on this level here. If we're going to bounce this time, we see that it will try to make a move to this 2471, 2470, and try to make its way up to this 2667. So watch for this level, 2470, essentially taking out this pivot high, then we'll be looking at this 2667. But if the breaks below this 2275, then we could see this 1960. But right now, I'm basically looking at holding this support here and pushes up at the 2470. And for gold, we're basically looking at gold at this 1804. It's been chopping around for so long. It's just a lot of congestion here, right? A lot of congestion. So, and it's holding up this trend line here also. So I'm still watching for gold to make its way back up to this 1923. As long as it holds above this trend line, and I wouldn't be surprised to see a little bit more chop at this 1804. But as long as this trend line holds, then I'm basically looking for gold to make a move to this 1923. But if we break this trend line, then we're basically looking at this zone here between 1716 and 1677. Now let's take a look at the ES, the Emini SP500, starting with this market profile chart. Essentially mark off two balance area. Remember this balance area, and these are just approximate based on eyeballing, the TPO, and then there's another one here that I have marked off. So you should see that right now this is Monday, Martin Luther King holiday. So the future is just kind of trading non-regular hour session. Basically, it is a holiday, so we're not going to take a look at it or pay too much attention to it right now. But the thing that I want to point out is that in the coming week, we're going to see will price come up and get back up to this zone here. Get back above this 4680 area, and bounce around and try to come back up to this top of this balance area, and also fill these, single print, and also complete this single print fill, and also this single print here. Okay, so that's the upside that we could be keeping an eye out on, is the single print fill that will act as a magnet. Then the other balance area is down here, which is on the downside. And notice that on Friday, it put in a poor low. So that's another magnet that it will pull the price back down to complete this auction, and by resolving this poor low. And if it come down here, then if it doesn't stay inside of this balance area and try to push back up, instead, if it come down, then I will be watching for this thing to migrate down toward this 4540, which is a December point of control here. Okay, the point of control made on December 20. So that is one of the levels that I will keep an eye on for the downside, somewhere around 45.3675. And finally, let's take a look at this chart here with all the major market indexes. Notice the New York Stock Exchange is the only one that made a new closing high last week. And here is when the Dow Jones Industrial made its all-time closing high, the last time that it closed with a new closing high. And here is the S&P 500. The transportation, the Dow Jones Transportation is way back here. So is the Nasdaq 100, the composite, the Nasdaq composite, and the Russell 2000. So we can see that right now we've been seeing non-confirmed closing high. Under normal circumstances, we will say that these non-confirmed high could indicating a top for that particular index, and also could be the top for the market. But we have to look at the context of the index itself, because right now we see the New York Stock Exchange Composite, which is a broad market index, and that made a new high by itself with a non-confirmed high. That indicates to me that there is still a newer high from one of these other major market indexes. And I'm particularly kind of biasing toward the Dow Jones Industrial because of the rotation from the tech and the growth stock into the value, and the industrial, the defensive stock. So it's tend to more favor the Dow Jones Industrial than the S&P 500 or the Nasdaq 100 indexes, or even the Russell 2000. Those are the small cap. From my past experience, I have never seen the market put in a top by the New York Stock Exchange Composite, because once again, that is a more of a broader market index. You cannot just move the index up or down by a handful of stocks, such as the Nasdaq 100 and the S&P 500. And with the Dow Jones 30, only consists of 30 stocks. So when I see the New York Stock Exchange Composite making a new high, that tells me that there could be another high coming for one of these other indexes. And right now, like I said before, I'm sort of focusing on the Dow Jones Industrial. So in summary, the internal, specifically the advance and decline, and the new high, new low, are telling us the weakness lies in the tech sector. Although a lot of the FANG stocks are still near the all-time high, but as the rotation toward the more defensive sectors continues, as shown by the new all-time high from the New York Stock Exchange Composite Index, the FANG stock and the tech stock will continue to be so. In time of rotation, along with the change in the Fed policy, one should be very selective on committing to new position, because the risk is when the rotation is completed, there will be no place to hide. So be sure to smash the thumbs up to help me promote and share this video. Thank you for watching and stay safe.